Welcome to the State of Nebraska moNEy video series. moNEy provides information regarding a variety of financial topics presented by the Nebraska Department of Banking and Finance and the Nebraska Department of Insurance. Today's topic is compound interest. Compound interest has been called the eighth wonder of the world. It can be a double-edged sword, benefiting those who use it to build wealth and burdening those who accrue interest on loans and dig themselves into deep financial holes. There are two concepts that you need to understand regarding interest: simple interest and compound interest. Simple interest is, well, simple. Simple interest is interest calculated solely on the principal portion of a loan or an investment. Compound interest is interest calculated on the principal, plus all accumulated interest from prior compounding periods. Put more simply, compound interest is interest on interest. Compound interest causes principal to grow exponentially over time. Let's compare two scenarios. Let's start with simple interest. Josh received a $10,000 inheritance at age 22. He puts his money in an investment that pays 7% per year. Each year, the investment company sends him the interest. It is not added to the original investment. Therefore, Josh receives $700 each year that he holds this investment. After 40 years, he has the original $10,000 investment and has received $28,000 in interest payments. Now let's look at compound interest. Josh's sister Laura invested her $10,000 inheritance in an index fund tied to the stock market. The index fund returned 7% per year, and the return was added to the principal amount. Laura did not add any additional funds to her investment. The first year, the investment grew by $700, identical to the amount of interest Josh received. However, in the second year, the value of Laura's investment increased by 7% of $10,700, or $749. Each year thereafter, the amount Laura earned on her investment increased because she earned 7% of the new balance, not 7% of $10,000. Laura held the investment for the next 40 years until she retired. Laura's investment, despite her not adding any more money to it, was worth almost $150,000. Time and compound investment returns caused Laura's inheritance to grow without adding a penny. The effect of compound interest becomes even more profound if you regularly add to your investment. Laura's friend Anita recognized early in life that if she routinely saved and invested, she could accumulate wealth and live a better life. She started investing at 22, adding $500 per month to an account which held an index fund tied to the stock market. The index fund returned 7% per year for the next 40 years until Anita retired. The initial $500 and the monthly contributions thereafter grew to almost $1.2 million thanks to time, compound interest, and Anita's investing strategy. When it comes to debt, compound interest can dig big financial holes. Brandon took out student loans to fund his education, finishing school with $50,000 in student loan debt at a 7% annual interest rate. Brandon was not able to find a job in his field with a competitive salary, so he entered an income-based repayment program to make ends meet, paying $200 each month. While the repayment program freed up money to help him pay his monthly bills, the loan payments were not enough to cover the interest on his student loans, much less any principal. After 10 years, Brandon had made $24,000 in loan payments, but his loan balance grew from $50,000 to $65,866. Time and compound interest caused his loan balance to grow. Troy wanted to go on vacation, but had not saved enough money. Instead of scaling back his plans, he booked a trip to Tahiti on his credit card. Troy was unable to pay off his credit card balance, and the interest charges began to compound. Troy went from owing $10,000 to owing more than $10,786 1 year later, even though he paid $150 each month. The credit card's high 25% interest rate meant that Troy's $150 payments didn't even cover the interest on his debt each month. How to make compound interest work for you. Don't just save, invest. To take advantage of compound interest, your savings must be in an account that pays a return on investment. Keep reinvesting your return to take advantage of compounding. Start as early as possible. Time is one of the most important elements of compound interest. The longer your money is invested, the more opportunities it will have to grow. A 25-year-old who puts away $500 each month until age 65 with a 7% rate of return would have nearly $1.2 million, while a 35-year-old doing the same thing would have only $567,000 at age 65. The earliest years of investing are the most important when it comes to compounding. Be consistent and patient. Consistent contributions to an investment account over time gives compounding more principal to compound on and can enhance returns. As Laura and Anita discovered, even modest contributions, paired with investment returns over long periods of time, can help you reach your financial goals. What can you do to avoid the pitfalls of compound interest? Be discerning about debt. Don't take on unnecessary debt like Troy did. Make sure you only take on debt that you can afford to pay back at an interest rate that won't hinder your ability to save for your future. Pay down high-interest debts. Pay off high-interest debts before the compound interest takes its toll on your finances. Create an emergency fund. An emergency fund can prevent your debt from increasing with every financial bump in the road. An emergency fund can help cover unexpected expenses like car repairs or medical bills. Having an emergency fund to handle these stressful events makes it easier for you to stay focused on getting out of debt. Bottom line, be cautious in taking on debt and understand how compound interest can derail your finances. Instead, make it your goal to use compound interest to your advantage and invest for your future. It is never too late to start investing. The time to start is now. Thank you for joining the Nebraska Department of Banking and Finance to learn more about compound interest. The moNEy video series is provided for informational purposes only. If you have a question about a banking or an investment matter, please contact the Nebraska Department of Banking and Finance at www.ndbf.nebraska.gov. If you have a question about an insurance matter, please contact the Nebraska Department of Insurance at www.doi.nebraska.gov.